Welcome to Lunch Money, your home for your online and social media home for workout, special situations and capital raising professionals. My name is Nick Samios. I am the fund manager at Hermes Capital and I am your Lunch Money host. Today we are coming to you live from the boardroom at ERA Legal. They are our sponsors today. You too could be a Lunch Money sponsor. All you've got to do is put up your boardroom and put up some sangers and you'll be a sponsor. How about that? That'd be fantastic. Now, I have with me my special guest, Paul Mazzola. Hello, Paul. Dr. Paul Mazzola. I'm going to introduce you shortly. Running a little bit late because there was a 5-car prang out the front of my office. There were police, people being face-planted into Botany Road. It was all very exciting, but that's for another time. Listen, when we're talking about what started World War I, people talk about the shot that was heard around the world. And they say, oh, the assassination of the Austrian Archduke Ferdinand in Sarajevo is what started World War I. But of course, the origins of that conflict can be traced back at least 40 years prior to that, to the Franco-Prussian War, if not earlier. I read a great book on this featuring Bismarck. If you're interested, let me know and I'll let you know what the book was. But the story of World War I can't be told absent the stories of the big personalities. Bismarck was one of the big personalities. Churchill was in there. Who else? There was Lloyd George. All of those guys. Big personalities. Big egos, I would have thought. Likewise, some blame the GFC, the global financial crisis, that some of us are old enough to remember, on spivs selling bonds backed by high-risk mortgage loans. But our guest today traces the causal patterns back to the American War of Independence. Which is quite fascinating. I did ask Paul when I met him actually to discuss this, why you didn't go all the way back to the Peloponnesian War, but
it could be my next
project. It could be the next one. We could have a chat about that. Please welcome Dr. Paul Mazzola. Can we have a big Lunch Money welcome for Dr. Paul? We do have a live audience. Now, Paul, when I first met you, you had a senior role at ANZ Corporate Banking Division, and you turned your back on that world, that world of high finance, known for big bonuses, a swanky lifestyle, probably what stays in corporate banking. What's the saying? We'll leave it there. And you left that for a life in academia. What don't you miss?
What I don't miss is the constant pressure from, and I guess it emanated from the shareholders, for increasingly higher returns. Now that translated to pressure from above, from the CEO, from the board, all the way down, and that generated a short-termism of thinking whereby results quarter by quarter were the be-all and end-all. In fact, in many banks, if you missed your targets 2 quarters in a row, you were under performance management. That constant pressure, I thought, created dysfunctional behaviours, which I also allude to in the book. I borrowed from those days in applying to the US investment banking industry, which also dealt with similar issues.
Listen, I'm interested. The first thing that you said is that you miss the collegiality. But I'm not sure that's entirely consistent with your book. Because not everybody in the banking circles, there are personality issues, aren't there?
There certainly are. In fact, first of all, can I start saying that not all my research focuses on investment bankers as opposed to bankers. There is a cultural difference, so we need to recognise that first. I was in both industries actually throughout my career, so I was actually at the coalface and could differentiate between the behaviours. Not all bankers are bad. We've had a pretty rough trot over the last couple of decades, actually. But it only takes a few, particularly at the very senior level, that can spoil the reputation of the industry.
Do you just mind holding up your book so that we can see, because we haven't announced the book, of course, but this is a countdown to the global financial crisis, a story of power and greed, which is a very sexy title. Did you come up with that, or was that your editor?
Actually, no, I came up with it. That's exactly what it talks about. It peels back the layers of the causes of the global financial crisis. It peels back the layers to the individuals and the decisions that were taken leading up to the GFC. As you mentioned at the beginning, I went back all the way to the American War of Independence to trace the behaviours. Initially, I went back to the immediate pre-GFC period and trying to seek an explanation for the behaviours that were observed. And in doing so, I thought I'd better go back to the previous major financial crisis, which was the Great Depression. And funnily enough, I found very similar patterns of behaviour and sequence of events. So I decided to go all the way back, and one of the interesting features was I found similar characters, similar patterns of behaviour, all following in a similar sequence leading up to the various financial crises.
I mean, I must say, when I read through, I went on the website and I've had a look through the contents and I've read some of the pages. What I found interesting was that obviously it's a very academic book in terms of, you're a PhD and it reads, it's very thoroughly researched and it's got all of those things that satisfy those in academia. But I do think that at first, on first blush, except for your use of power and greed in the title, you might pick up that book thinking that it's going to be all about finance and all about junk bonds and all that sort of stuff. But actually, there's a lot of human nature and power in that. Listen, let me get back to the script. Earlier on, we were talking, and you were in Europe earlier this year, visiting the European Parliament. What were you doing there?
Well, I was very flattered and honoured that I was invited to present to a committee of the European Parliament. The European Union's going through some significant change. They've recognised that the ethical frameworks governing all the various European institutions, and there are actually quite a number of them, have been dysfunctional and not effective. So they want to undertake a fresh look at how they govern these institutions and the ethics. There's been a number of cases where European parliamentarians have been seduced into the industries that they were regulating. And that's a form of regulatory capture.
So would this be, again, without naming names, but would this be a little bit like Julie Bishop going to join Greensill? Or
we have existing
other politicians going to Morgan Stanley and all these.
Precisely.
Or Josh Frydenberg, where did he go?
Barilara's
Goldman Sachs,
recent fiasco as the trade minister. That's another example. Now, I'm not saying they're all.
We're not picking on them.
No, and I'm about to say they're not all bad practices because they may well be the best person for the position. But generally speaking, we do see evidence that from taking those positions, there are clear and obvious exploitation of the power that's afforded to those individuals, and often it's monetary.
I listened to Scott Adams, the famous cartoonist of Dilbert, and he says that if there's a reward and a way of committing the crimes happen. So if you can think of a crime where there's a reward and a way of it being executed, it's happened. And so I wonder if there's a bit of that. Listen, having a look at some of the highlights of your book, it occurs to me, a lot of people say that an MBA is very useful if you want to be successful in finance. And you do an MBA, and there's lots of people that are aspiring merchant bankers and investment bankers, merchant bankers, showing my age there. But does it also help to be a psychopath?
Many would say yes. I hope I'm not a psychopath, but it's interesting you asked that question because there's actually been a couple of academic studies on this, although not focusing on psychopathy, but on narcissism. In fact, a Harvard paper of 2021 identified 20% of American CEOs as qualifying under the narcissistic tag. Now that compares to 5% of the population. So it's over three times the number.
Wow. Would anyone in this room concur that there are psychopaths operating the financial services?
To get to the top.
Yeah, okay.
Another paper in 2020 then looked at whether this also applies to the finance industry and in what degree. And because narcissists very much motivated by self-interest. Money is used as a tool for power. And given that you were saying that education is important to get into investment banking, it's because it's very selective. It's very hard to get into, and because the rewards are the greatest of most industries. So money is very important to those who want to get into the industry. Once they're in the industry, they will use that money. If they're narcissists, they'll use it and manipulate others by using it. The reward systems, their own personal self-interest, all that comes into play. And that goes to some way in explaining those differences in the percentages of the population that are narcissists.
You do, yeah. I mean, you do specifically talk about psychopathy, if that's the correct pronunciation in the book. So that's interesting. I mean, I know that when I was at your book launch, I was very privileged to be there, and thank you very much for inviting me. I asked you, well, I said to you, and I don't know if there's a good way of saying this without it being misconstrued by people, but Gordon Gekko, said greed is good, and you don't think greed is good. On the other hand, what that means is that people are obviously going to have behaviours that have the rewards. If you want people to exhibit certain behaviours, then you set the reward structure as such. But you would contest with Gordon Gekko that greed is good.
Well, I think in that era, and that was the 1980s, it was a mantra. It was an accepted practice, but at all costs. So the notion that greed is good at all costs is what I object to, because I think there is a duty to public benefit. And that's where regulators actually step in, is to hone in those dysfunctional behaviours to ensure there is no harm to the public benefit.
Do you know, when I first met an investment banker, it was a social setting, and there was two of them there. They were friends of a friend, and they used this expression, tearing the face off a client. Have you heard that?
I've heard it in other guises.
Yeah, and it basically means, and I'm thinking, the client is your client, and you guys are using the expression like tearing the face off to mean that they were absolutely gouging them on fees and God knows what. I mean, maybe it's not used these days, but yeah, I mean, I'm going back a bit.
That is right. I mean, I was around in the 80s like you were, Nick, and we saw a lot of that. In fact, that was one of the main reasons I left the industry.
Yeah.
I couldn't stomach what I was seeing. In fact, there were sayings that if you were shaking hands with someone from Lehman Brothers, check your fingers. You might have lost a few. But it's encouraging to know that integrity is now even included in some regulations. In fact, the BEAR regulations that APRA oversees actually stipulates that and compels ADIs and senior executives that are governed by that regulation to act with integrity. We saw that coming out of the Haynes Royal Commission. So many examples after examples where integrity was breached, or the notion of that. So that's what we probably were missing a little bit in the 1980s. To get to understand that in the book, I had to explore certain theories to help me understand why that occurred. Well, one useful theory was what we call new institutional theory, and that was a theory put out by a couple of very intelligent academics, DiMaggio and Powell, back in the early 80s. And new institutional theory talks about pressures to conform. One particular strand called normative isomorphism, or normative pressure, talks about how individuals within an industry or within a field can normalise certain behaviour because they see it all around them. And there are all kinds of communication amongst that group that makes even that kind of behaviour that you've just described seem normal. So,
okay. Look, I might just ask you to pass the book there for a moment. For those, anybody who's just joined us, I'm here with Dr. Paul Mazzola, and we're discussing his new book, Countdown to the Global Financial Crisis, A Story of Power and Greed. We are coming to you live from ERA's boardroom, ERA Legal's boardroom. They're our sponsor for today, and you too could be a sponsor of Lunch Money if you want to put your boardroom up and put on some sangers for the guests. So, Paul, okay, so the lust for power and greed, as we said before, they're kind of inevitable wherever you go. My written question here is, what surprised you or even shocked you about human nature and investment banking? We've kind of talked a little bit about that. I'm just interested, maybe instead I could ask you to join the dots between George Washington and the War of Independence and the GFC.
Yeah, well, as I said, I traced the patterns of behaviour all the way back to the American War of Independence, and I was looking for the very first investment banker in the United States. I came across this character called Hames Solomon. He was quite a character, came from Europe, spoke various languages, quite an intellect, and was a supporter of the independent movement against the British, and noticed that to win any war, one needs money, one needs finance. And because of his network and connections, and again, I'll come back to that word network, because one of the key attributes of an investment banker is having a good network for distribution. So he had a fantastic network and was able to raise money through the issuance of what we would know today as capital markets instruments. And moreover, he was quite a wise guy who was able to use his connections. Again, another attribute of
Wise
an investment
guy and
banker.
connections. It sounds like
something mafioso, probably.
Yeah.
One of the things he did was he granted interest-free loans to a great number of congressmen. In those days, it wasn't a proper Congress. It was called the Continental Congress. And in return, sought some favours. One of the favours, I guess you could call it, was to almost usurp the authority of the Treasury Secretary. So he just stepped in and raised the funds that the new government needed. And of course, to prosecute the war and also to fund the post-war period. So that continued for quite a while. In the meantime, running his own investment banking activities and taking a clip on all the transactions. So there's a smart investment banker.
Cicero said that the sinews of war are endless money.
That's right.
Interesting, right?
That's right. So you asked the question, how do you relate that to the GFC? We saw a lot of examples of power and influence impacting on politicians and regulators in the lead up to the GFC. There are a number of, and I plot these in the book, a number of regulations that were enacted previously following previous regulations that were repealed in the period prior to the GFC, solely due to the American system of lobbying and the power of the institutions that drove that lobbying.
Now, somewhere along the line, and I'm sure it's in your book, I know that Peabody is mentioned in your book, but Peabody had something to do with funding World War I, was it? Or maybe...
There were most wars, in fact, in the US, were funded by investment bankers, by Wall Street. In fact, New York was the centre from the early days. And in 1912, there was the Peugeot Committee, which was constituted to look at what they called the money trusts in the US. And these are the very wealthy bankers in New York, and they were concentrated. The power was all concentrated within a very short area. And the outcome of the Peugeot Committee was the establishment of the Federal Reserve System. So there was an acknowledgement that the monetary policy was actually being conducted privately by the money trusts.
Well, I'm part of the End the Fed movement, and if we've got time, we might come back to talking about ending the Fed. But look, when studying the history of warfare, often we hear the refrain, the generals were fighting the last war. Classically in World War One, they were using battle formations that were quite successful against the muskets and cavalry of Napoleon. But of course, the Germans had mechanized warfare with all sorts of machine guns and what have you. Are our regulators today fighting the last war? How well equipped are we for the challenges today? There's high interest rates now. We've got inflation. We've got all sorts of new technologies, we're delegating credit decisions to algorithms in many senses. When you and I started in banking, and I started down at Wales House, and downstairs there was corporate banking, and those people made their own decisions. But of course, then it was centralised, and even the branch manager can't make a decision apart from. I don't know what brand of coffee, I suppose, to bring in.
That's right.
So are we equipped?
Well, back first of all, a couple of those comments. Yes, there was a world of gentlemen bankers back a few decades ago, and technology and innovation has made a big difference to decision making. So we'll park that aside for the moment.
But just if I could say, there was a 3-3-3 rule. Do you know the 3-3-3 rule? Interest rates 3%, golf handicap 3%, and I think the 3 p.m. knockoff or something that's a long way back.
I would love those days again.
Yeah, oh God, yeah.
That's right. So one of the things I trace in the book, and which really caused a massive expansion of the US investment banking industry, was the simple corporatization. Early on, up until the early 1900s, most investment banks were partnerships. And once they started to corporatize, things like tacit skill and reputation were devalued, because an executive or a senior executive within an investment bank could hide behind the corporate veil. And it was all about corporate profits, not partnership profits. A partner's reputation was what sustained the firm. And so the individual was held accountable. Now, they can hide behind that corporate veil, and it's the corporation, the separate legal person, the separate legal entity that is responsible for the decisions and suable for the decisions made by the senior executives in these investment banks. So that evolved to then the internal management constructing their reward systems. And their reward systems obviously were driven by self-interest, and that's why you hear about the $50 million bonuses and so on. That would never have happened under a partnership in the old days, because it was for the greater good of the partners and the several liability and joint and several liability that they had in mind in undertaking their business practices.
That's very interesting, yeah, because I know the structure you're talking about. I mean, some hedge funds operate on those structures to some extent, where there is partnership and liability. We've just had a couple of questions here from the floor, so let me read one of them to you. Has crypto got the potential to override all of these controls and outsource monetary policy to corporations? To go outside
That is a very good question. In fact, I've written a little bit about this. One of the biggest threats to central banks around the world is the emergence of cryptocurrency. The crypto market is quite a diverse market, so let's not confuse the various segments of that market, but the currency side of the market, which is coins like Bitcoin and Ethereum, etc., can destabilize the way governments manage their economies through the exercise of monetary policy through their central banks. Because monetary control of a country's currency, of a country's legal tender, is essential to manage monetary policy, because monetary policy is all about either injecting or taking out cash from the economic system. And if money is in a different form, which is in itself decentralized, like these cryptocurrencies are, there is no country backing a cryptocurrency, it's totally decentralized. If that gains a majority of the transactional flow within an economy, then the hands of central bankers are tied. So this is the danger imposed by cryptocurrencies. One of the early responses to this is I can see it, many of the governments are establishing their own digital currencies as a competitor to other currencies, but they're only competing against stable coins, not the volatile Bitcoin. So again, it's a very complex. It's a very complex market.
Well, Warren Buffett calls it rat poison, doesn't he? There was a stable coin that kind of was not so stable
Called
recently.
Terra, and so there's a real push for regulation around that right now.
Yeah, I mean it is a fascinating area. Just a reminder again that I'm here with Dr. Paul Mazzoli. We're talking about his book Countdown to the Global Financial Crisis, and you're live on Lunch Money, and we're here sponsored today by ERA, and you're welcome to sponsor us if you have a vacant boardroom and a plate of sandwiches. We'll come and do one live with you. I've got another question. Oh, just a reminder too that if you are watching, you are of course via YouTube, Facebook, or LinkedIn. You're able to pop us a question, and we will gladly put it to Dr. Paul. Now, I've got this is partly written in English. This question. I think we've got a doctor in the audience. You say bankers have institutional conformity, but are not the government institutions also along for the ride until something goes wrong? Does that make sense? That question. Hang on.
That is a good question.
If you know what, if you can see these patterns, why can't we legislate before rather than after? That's interesting. So,
well, this is something, as I said, when I traced back to the history of financial crises, one of the patterns that I was referring to was the pattern that regulation often follows crises. Good times come back, economies flourish, and what happens? The politicians who are responsible for legislation, in their pursuit of popularity, tend, especially if they're on the right side and want to garner support from the business community, and which includes the finance community, have a tendency to repeal restrictive regulations. Now, we've seen this time and time again. Let's look at the Great Depression and the Glass-Steagall Act that was brought in 1933. It took 70 years for that piece of regulation that prevented banks and investment banks from co-forming into one entity. So a traditional bank would then undertake much riskier business that an investment bank would undertake. It took 70 years for that to be repealed back in 1999. I trace that as one of the key factors leading into the GFC. Now, what happened after the GFC in 2010?
So what was Glass-Steagall?
Glass-Steagall was the regulation that prevented banks merging with investment banks, because banks are sacrosanct. They hold deposits of mums and dads. The last thing a government wants is for a bank to go bankrupt. But if they were to merge with an investment bank, they actually increase the risk profile of the combined institution, and that's what that contributed to the Great Depression when those merged entities failed. That was repealed in 1999 with the Gramm-Leach-Bliley Act, which we could see this coming. That meant that banks like Citibank could now undertake investment banking activities and risk up their business. What happened after the GFC? We had quite a good regulatory framework called the Dodd-Frank Act. Now it took 7 years for Trump to repeal a major portion of the Dodd-Frank Act over two separate pieces of regulation that repealed those essential provisions that required banks to be stress tested to report on certain risks. That repeal still exists. So the lesson that I learned, and in answering that question, what I fear is this pendulum effect, this shifting nature of power between industry, between the finance industry and between legislators. And this shifts after every crisis and before every crisis. So,
well, it's interesting. I mean, when I started at Westpac, and then I worked at AGC. And of course, prior to deregulation in Australia, Paul Keating's great deregulation back in the early 80s.
84, 85.
Yeah, I mean, banks weren't allowed to own leasing companies, for example. So you didn't get your equipment finance from Westpac. You got your equipment, and that's why they owned these other. Well, they had shares in these other companies, but they didn't. They didn't own them. So was that a hangover from this Steagall type?
Well, the Glass-Steagall Act applied only to the US jurisdiction.
I just wonder whether or not it influenced.
That the notion of banks undertaking non-banking business has long been a contentious issue, and because of the risk that it brings on the balance sheet of banks.
Now, my thought bubble earlier, which I forgot but now I remember because I've written it down. When you were talking about the cryptocurrency, I was thinking about gold because I always wonder why not gold's better than the. And are you familiar with the Wizard of Oz as an allegory?
No.
No. Yeah. Well, Oz, OZ. If I write it like that, you suddenly realise that it's ounce, and it's all about fiat currency and the yellow brick road. And the Wizard of Oz was like Wall Street, conjuring up all of this sort of fake money. If you Google sort of Wizard of Oz as allegory, it is quite fascinating. So that, as I say, that was just a thought bubble, and my apologies for that, but I had to get it out.
Very interesting.
I'll remember. It is quite fascinating when you think of the Wizard of Oz behind the curtain.
I'll remember that for one of my lectures.
Yeah. I mean, look, I would recommend to you. A lot of people will sort of wince when I say that, but Ron Paul wrote a book called The Case for Gold, and he talks about that. But now, look, you talk about regulation. Now, I've got a bit of a controversial question here. Why do we need so much regulation? Would we not be better off if banks were allowed to fail? If you had competition, if banks were competing for deposits, and the competition wasn't about interest rates so much, but about sound management and a track record, wouldn't that be a better way of making sure that banks behave themselves? I mean, if people thought that a bank could fail, they would think twice about where they stick their savings. And I personally think that banks should have been allowed to fail in the GFC. And I think it was a big moral, there is the moral hazard, obviously. But if more banks had been allowed to fail, then maybe, maybe we wouldn't have had the crazy lending and all that. You would say, obviously, consumers need protection and all that sort of stuff, which is a counter argument. But why not have less regulation and allow failures and then it would become part of our culture that banks can fail. And so you need to do your homework, get the recommendations. Maybe research firms could provide ratings and that sort of thing.
Nick, you're quite right in that this is a very controversial issue. In fact, it occupies a lot of academics' time in our research. And what I can say to you is that I think it's dangerous to go to one extreme or the other. Obviously, over-regulation affects efficiency, market efficiency, and profitability of banks. We want banks to survive. We want banks to strive because they're an essential component of any economy. On the other hand, there's what we call the public interest. Mums and dads aren't equipped to understand and analyse financial statements of complex organisations. It's hard to find an organisation more complex than a bank, with all the various divisions, with all the various business operations, including from treasury, dealing, derivatives and so forth, corporate lending and so on. So given that inability to understand the risks that they're confronted with when they deposit their hard-earned savings into a bank, protection of that consumer is vital. The last thing a politician wants is for a consumer to go bankrupt, given that there was a lack of regulation over the banks which they rely upon. So politics comes into play as well.
I guess a corollary of if you're going to guarantee deposits, well then just a world of regulation comes with it, doesn't it?
Yeah, and guaranteeing deposits is dangerous. We did that immediately after the GFC, but that was a temporary measure.
Well, it saved. Look, I don't want to name names, but there are certain banks that it saved.
That's right.
And there was one bank in particular. I remember on the Saturday mornings on the sideline watching the kids play sport. There was one guy, and he was very senior in one of these banks, and he was, they were just gone. He kept saying every weekend, "We're gone, we're gone, we're gone." They got the bank guarantee, and then they went on the warpath acquiring all of these other financial institutions and assets, loan books and what have you, because all of a sudden they were able to raise the capital. And there were these other little institutions that weren't guaranteed, they weren't part of the banking system. They couldn't raise capital. They had runs on them. I remember there was one called Bigi Finance. So then because of that intervention, there was a distortion, if you like, because these other finance companies should have survived, really. There shouldn't have been a run on them. But because the banks were being guaranteed and some,
Not only does it create an unlevel playing field and a disproportionality in the market between ADIs and non-ADIs, it also creates what you alluded to earlier, which is moral hazard. If a bank CEO knows that the deposits are guaranteed, that all his funding is guaranteed, that creates an environment whereby the CEO may make riskier decisions knowing that he or she will be bailed out. That moral hazard is very dangerous. That's why
all care and no responsibility.
That's right. That's why the government guarantees over our deposits in the early period post GFC was temporary and gradually wound down. That was effective and often cited as one of the key components that allowed Australia to avoid a recession. One of the few countries to avoid a recession post GFC.
Well. Yeah, obviously Australia's balance sheet was in pretty good shape going into that as well, and we had good regulation, but I just wonder now again when I started at AGC way back when, back when Moses was playing fullback for whatever that saying goes, I started in collections, and chasing bad loans and late loans, and the theory was that everyone starts in collection, so you know what a bad loan looks like, you know what it is to have to chase money, you know all the things can go wrong, and then later you go through that process and you get promoted and go through that process, and then you get on the desk writing loans, but you don't get on the desk writing loans until you've been on that other side of chasing arrears and workouts and all that sort of thing. Now that culture completely went, even in the 90s, let alone, I started in the 80s. These days, you see some of these fintech startup and you look up the people, none of them have got finance background. I'm generalizing there, but some of these, you look at them and you say, well, this person's a marketing person and this person's come out of some other a lot of IT people, and they haven't had that experience. That worries me a little bit.
It worries me too. In fact, I think if you do a survey of a lot of financial institutions, not just here in Australia, but all around the world, a lot of CEOs just have sales backgrounds. It's all about selling. It's all about selling mortgage product. It's all about selling other financial products, and then the cross-sell that goes with that augments the organisation's profit. So that's dangerous. And I think there's no better training from the one you had is to see companies go bad and deal with bad credits to hone in your credit judgment, because that's, as you say, a lot of that's missing these days.
Now, look, we are kind of going a little bit over time, but it's such an interesting discussion. I don't really care. We're going to keep going. But look, you did send me some slides, so I think in fairness, so there's the book again, of course. I just thought now who's that guy?
The founder of Lehman Brothers, one of the three brothers. He was the eldest who first came to America. And I thought this would be an interesting slide, and we'll contrast that with another one in a minute. He came from a merchant background. He came from Germany. Well, in fact, Bavaria, because Germany hadn't been unified at that point in time. And
when was this?
This is back in the early to mid 1800s.
Right.
And then he started off in Alabama as a cotton trader. This is not dissimilar from a lot of other early investment banks. You think of so many names like Goldman Sachs and Lehman Brothers, Bear Stearns. They came from similar backgrounds, from trading backgrounds. For example, the Lehman's father was a cattle merchant and also a merchant trader back in Bavaria. And when his name's actually Hayam Lehman. He changed his name to Henry when he came to America to assimilate into the culture. He was pretty smart. He had two things working against him in the American system. One, he was Jewish, and two, he was foreign. So to get business going and to assimilate, he changed his name and then realised that by accumulating stores of cotton, he could have an impact on the price of the local price of cotton. Remember, we didn't have the communications that we have now. So a lot of the pricing, the market was
cotton was hard currency though. Back, I mean, if you look at the history of the Civil War, I mean, the South there was cotton, and I won't go into all of it, but that was, they presumed that they'd be able to keep selling their cotton to Europe. But I mean, it is hard
he would
currency.
sell his merchandise,
yeah,
and the payment, a lot of the payment was in cotton.
Yeah,
and that's how we accumulated cotton, built silos and so forth. Yeah. A lot of the securitization that we see today is based on the principles that he founded on accumulating, pooling stock.
Cotton receipts
of cotton, and then he would sell share ownerships into those stockpiles.
Wow.
So there's your first securitization.
All right. Again, Ron Paul's Case for Gold talks about the origins of money. He doesn't talk about securitizing cotton, but maybe he should revisit that. Now, who's this chap?
Isn't that an interesting picture? It says a lot. You know, this is Richard Fool, the last chief executive officer and chairman of Lehman Brothers. His nickname in the office was the Gorilla, and I guess you look at this picture and you can understand why. Came from the trading division of the firm, fought hard to become CEO, and ruled the firm with an iron fist. And when things were tough, neglected all the wise advice that was given to him by his leadership team. So he was one that really sourced, managed, and manipulated power, and then used it. So that's why my book talks a lot about power.
All right, now we'll come back to your other slide, but we do have a comment here, and if I blow my screen up, I'll be able to read it. Are restricted ADIs sufficient to reignite sound lending or banks that do not deal in derivatives exotics? So,
yeah, there's a classification of ADIs that are called restricted ADIs. That means they can't undertake every activity that a fully licensed ADI does. Because remember, banks were traditionally intermediaries between borrowers and savers. It's quite a simple business in that regard.
Yeah.
Once you start adding on all these other activities, trading, warehousing, securitizing, and so on, you're raising the risk profile of the institution. So that's quite a relevant question.
Well, interesting. I mean, my business, Hermes, we're a fund, and I guess we're like what banks used to be. We've got a pool of investors. We pool the money and we lend it out. I mean, that's right. It's as simple as that. And we're monitored by ASIC, obviously. We're licensed by ASIC, but and
the skill there is not to lose it. So credit judgment.
That's the first rule.
Credit judgment is so important. And earlier you said about the innovation and technology overriding old practices. And the best at innovating are the investment bankers. They brought us VAR, value at risk models. They brought us the credit metrics models that are numerical models that measure credit risk. In other words, deferring human judgment to computer models to rank risks for decision making. Most sensible banks will use that as one of a number of tools in making decisions, but there are segments within banks that solely rely on, for example, credit scoring in their decision-making process.
Okay, I'd just like to thank that LinkedIn user. For some reason, your name hasn't come up, so I can't thank you personally. There's a glitch in there that I don't fully understand, but thank you very much for your question. Now, I think Paul had given me one more slide. Oh, no, he hadn't. I'd given me one more slide. I just thought this was interesting because it was in the paper today. This story of Bill Pappas and Forum It is a fascinating story that Westpac and a bunch of other lenders are in all sorts because he was basically selling them loans that didn't really exist. I think the story goes that one of his borrowers was a big corporate, and they've tried. You know how it works in the corporates. That particular borrower tried to get some money off the bank for whatever it was, some legitimate purpose, and they said, "Well, we're terribly sorry, you're over your limit." And then the borrower said, "What the hell are you talking about?" And they said, "Well, you've got all this other stuff over here." And it turned out the other stuff was a bunch of fake loans. But what was interesting was that Westpac, I think, had acquired its relationship and exposure initially because they acquired Capital Finance, which I think is where this is all in this article here that was in today's Australian. But it's amazing how, I've been around for a long time. These stories happen again and again and again. You think, does anybody ever learn? I mean, you were talking about, you'll tell us a little bit about Friedrichsen.
Yeah.
But then there was another one called Tonal. Do you remember Tonal?
No, but I do remember the Safety Council of Australia.
Well, tell us about
this
that.
is almost a facsimile of that. This is identical circumstances. With the Safety Council, Friedrichs, the Safety Council of Australia, the National Safety Council of Australia case.
Just give us the
CEO,
the sketch of that.
The CEO faked invoices, sent those invoices to the bank for an asset finance transaction. In other words, raising money on the basis that the loans were secured by assets, real assets. Often the assets were safety equipment because that was the business of the National Safety Council. The assets never existed. These were fake invoices.
I think there were some assets.
There were some.
But I hear that sometimes the banks would go out to inspect them, and they'd go to one site and there'd be a few trucks or whatever, and they'd inspect them. And he'd say, "Listen, let's go and have some lunch, and then we'll go to the other site and inspect the other trucks." Of course, meanwhile, those trucks were then driven to...
Not only that, but he would invite different banks to inspect the same asset. So he was doubling up on that. So that is almost an identical case. So what have we learned? This was in the mid-'80s from memory, mid to late 80s, actually. I think 88, 89, something like that. What have we learned? One of the problems I've witnessed in our banking industry, we lose corporate history. We get rid of very good credit managers. If there was a retrenchment program, it was these elder credit guys that would be retrenched first, and the newer generation of credit decision makers would come in without the corporate history. Now, banks are renowned for making the same mistakes.
Well, let me make one point. Firstly, just a reminder that I'm talking with Dr. Paul Mazzoli. We're talking about his book here, Countdown to the Global Financial Crisis, A Story of Power and Greed, which is very sexy. And just further to that point, you talk about corporate memory. I've got a lot of friends who are commercial finance brokers, and they have their clients for, some of them have clients for 20 and 30 years. But even if they've had their client for 10 years, I often say to them, the broker has the corporate memory of that client, because they leased a car for them 10 years ago, and then they may have done the mortgage 9 years ago, and a whole bunch of manufacturing equipment and trucks, and they know the file. And they know that 7 years ago something happened, and they made red boxes instead of blue boxes, and so their sales declined, but then they bought this other, and they've got all of this memory. The bank doesn't have that. All the bank has, because the bank manager chops and changes, and then there isn't even bank managers anymore.
And that dovetails into what I was saying earlier, how that a lot of the credit decisioning these days is process driven, often with the help of technology. So the human element, the judgment, falls away. What would you have done differently? I would have gone out there and observed the asset, kicked the tires, so to speak, and to know that there was a real asset there securing the loan. That's just a common practice that was done in the old days.
Well, this is one of the problems with this Pappas matter, was that they were just selling paper, selling loans, and no one was checking. It's just I don't know exactly what happened, but obviously someone wasn't checking. Certainly in my business, there's a simple verification process. You make sure that the piece of paper you're buying is legit. because if it ain't legit, it's not going to get paid. So there's that. I mean, one of the funny things I remember about John Friedrich and this National Safety Council that you were talking about. Did you listen to Roy and HG at the time? Well, he went missing.
That's right.
He went missing. This guy, he was on the run. He's owing God knows how much money. And Roy and HG used to have the Saturday afternoon sports program. And they made this announcement: if you're at the footy, just turn next to the guy next to you and say, "Are you John Friedrich?" And they were hoping to have this national thing. It was hilarious, to try and find him. Listen, we're going to wrap up. Any sort of closing comments, Paul?
Look, I might just close with a saying by a famous philosopher, George Santayana, in 1905, who said that for those of us who fail to remember the errors of the past, we're destined to repeat them in the future.
Okay.
That's true.
That is true. All right. Well, thank you very much. If we could give Paul a thank you. Thank you very much. Okay. Well, thanks for joining us. We're going to be doing this live again next week from a restaurant, so that's going to be a lot of fun as well. Hopefully, there won't be a pile up of 5 cars and police and crooks out the front of my office that time, and I'll get here a little bit sooner to be able to set up. Thanks for watching, and we'll catch you again soon. Cheers.